Whether they're buying, selling, or renting a house, real estate plays a vital role in the lives of the majority of people. Property valuation, or the process of figuring out a property's market value, is one of the most important elements of real estate. This is crucial because it enables buyers and sellers to recognize the value of a property and make informed decisions. So, in this video, we'll go over some fundamental concepts and methods related to property evaluation. Without wasting much time, let's get started. When purchasing or selling real estate, it is crucial to understand the valuation and pricing of the property. The following are some key concepts in property valuation. The projected price of a property would sell for under the current market circumstances is its market value. It represents the point at which a willing buyer and a willing seller would agree on a transaction. Location, size, condition, amenities, supply and demand dynamics, and recent comparable sales in the neighborhood are all factors that affect market value. An appraisal is a professional assessment of a property's value conducted by a licensed appraiser. A variety of techniques are employed by appraisers, such as comparative market analysis, income approach, and cost approach. CMA compares recent sales of comparable properties, then income approach examines the property's potential income, and the cost approach assesses the property's replacement or reproduction cost. When determining the property's value for a mortgage, lenders frequently require an appraisal. A CMA is a report created by a real estate agent to assess the worth of a property by comparing comparable, previously sold properties in the neighborhood. It takes into account elements including location, size, condition, and amenities. CMAs are frequently used by both buyers and sellers to determine the market worth of a property. The assessed value is the value assigned to a property by a government authority for tax purposes. Market conditions, the size of the property, and upgrades can all be used as basis for assessments. Property taxes are determined using the assessed value, which is often less than the market value. The cost at which a seller puts a property for sale is known as the listing price. It can be influenced by the seller's expectations, market conditions, advice from real estate agents, and the property's estimated market value. The listing price aims to attract potential buyers and initiate negotiations. Property value is affected by a number of things. These include the property's location, its closeness to amenities such as parks, schools, and shopping areas, how desirable the neighborhood is, the size, age, condition, and architectural style of the property, as well as any repairs or upgrades, the views, the accessibility, the market circumstances, and the economy. Overpricing a property can cause it to spend more time on the market and turn away potential buyers, while underpricing could draw fast offers. It can also result in money being lost. Analyzing market data, taking into account the property's attributes, and weighing the seller's objectives against market realities are all necessary when valuing a property correctly. Well, there are several methods of property valuation, each with its own advantages and disadvantages. The sales comparison approach, the cost approach, and the income approach are the most popular methods. The sales comparison method is based on the substantial principle, which holds that a buyer would not pay more for a property than it would cost to purchase a comparable property with the same utility. This approach compares the subject property to comparable homes that have recently sold nearby, taking into account elements like size, location, and condition. The cost approach is based on the replacement principle, which argues that a buyer would not pay more for a property than it would cost to build a property with comparable features and utility. This approach entails estimating the price of erecting a brand new structure on the subject property, accounting for elements like labor, materials, and builder's profit. The income method is mostly applied to properties that generate money, like rental homes or commercial buildings. Using a capitalization rate, this method entails assessing the anticipated future revenue from the property and turning it into a present value. The capitalization rate is calculated by examining the risk involved with the property and the expected return on investment for a buyer. It's critical to remember that property valuation is not a precise science, and various approaches may produce different outcomes. When it comes to estimating a property's value and pricing, consulting with real estate experts like appraisers or seasoned agents can be a great resource. With that, we wind up today's video. Let us know what you think about property valuation and pricing in the comment section below. If you find the video informative, press the like button, and if you haven't already subscribed to our channel, please subscribe to our channel to watch more informative and interesting videos like this in the near future. Goodbye.